All right, let's dive into a real head-scratcher from the semiconductor world. We're talking about a company called Marvell Technology and a stock market reaction that honestly looked completely backward.
So get this. Here's the paradox we're going to unpack. Imagine a company's AI business doubles. I mean, that's incredible news, right? But then they also say their profit margins are shrinking. Now, normally, that would send a stock plummeting. But with Marvell, the stock actually went up. So what on earth was going on?
Okay, so let's start with the good stuff. And I mean, it was really good stuff. Marvell came out and said its revenue from AI customers had straight up doubled compared to the year before. For a company that's basically building the plumbing for the AI revolution, that is a massive signal. Demand is just exploding. But, and this is a big but, here's the twist. Even with sales going through the roof, the profit they were making on each of those sales, the gross margin, was actually going down. See, Marvell was making these special lower profit deals to lock in the big fish, the major clients. And 9 times out of 10, that's the kind of thing that sends investors running for the hills.
So you've got these two totally conflicting signals. How do we make sense of it all? Well, the clues are buried inside their Q4 2025 earnings report. It's a classic puzzle, and to solve it, we've got to look at both sides of the coin, the good and the not so good. And this table just lays it all out, plain as day. You've got AI revenue doubling, huge win. But then you've got gross margins dipping. That's a big red flag. So why in the world did the stock rally? That's the billion-dollar question we're here to answer. Okay, before we get any deeper, let's just make sure we're on the same page about gross margin. Think of it like this. For every dollar a company makes in sales, the gross margin is the percentage of that dollar they actually get to keep after paying for what it costs to make the product. So a lower number means less profit per sale. And when that number starts dropping, investors get nervous, really nervous. And hey, it wasn't just us who were confused. You had seasoned analysts, people who do this for a living, just scratching their heads. I mean, everything they knew said the stock should have been punished for this, not rewarded. So you have to ask, what did Wall Street see that almost everyone else missed? Well, it turns out the smart money was playing chess while everyone else was playing checkers. They weren't just looking at this one report in a vacuum. Nope. They were connecting the dots, looking at all the moves Marvell had been making recently, and that's where the real story started to take shape. And check this out. In just over a month, Marvell went on a shopping spree. First, they grabbed Celestial AI. Then, they announced that the biggest cloud companies, we're talking the hyperscalers, were using their PCIe retimers. And just think of those as like high-speed boosters for the data superhighways inside AI servers. And then they snapped up another company, XCon Technologies. You see the pattern here? Every single move was laser-focused on one thing, owning the critical hardware that ties all these AI systems together. So their game plan was crystal clear. This wasn't just about selling more chips. No way. This was about making themselves absolutely essential, indispensable to the biggest tech players out there. But even knowing all this, it still doesn't fully explain away that shrinking margin. There was another piece to the puzzle. The real answer, the thing that cracked this whole case wide open, wasn't in some flashy press release. It wasn't in a headline. It was buried deep inside the company's official statements, just waiting for someone to dig it up. And this is where the real detective work paid off. See, while most people were getting hung up on that shrinking margin, a few sharp analysts kept digging. And buried in the transcript of the earnings call, they found it, the real story. And it all boiled down to one single, absolutely game-changing number. $73 billion. Just let that number sink in for a second. And this wasn't some pie-in-the-sky forecast. This was a backlog, a locked-in, confirmed pipeline of future business, stretching out for years, with the biggest names in the game. Think Google, think Meta. This was real. And a $73 billion backlog? That changes everything. It gives them this incredible crystal ball into their future revenue. It proves they've already secured the biggest AI customers on the planet. And all of a sudden, taking a little hit on your profit margin right now to lock in a massive, guaranteed future, well, that doesn't look like a problem anymore. It looks like a brilliant move. Okay, so let's tie this all together. The final verdict is in. This whole Marvell margin mystery, it wasn't really about one bad quarter. It was about something much bigger. The classic choice between short-term results and long-term vision. You had two ways to look at this. You could fixate on the short term, right? Worry about the lower profits today. Or you could do what the smart investors did. look at the long term, and see a company that just guaranteed itself a massive river of cash for years and years. And in this case, Wall Street bet big on the future. So the big takeaway here is really a powerful lesson for how you can analyze any company. Don't just stop at the headlines. You've got to dig deeper. Look at the strategy, look at the recent moves, and always be on the hunt for that one key piece of data, like a $73 billion backlog that tells you what's really going on.
When you boil it all down, the Marvell story is just a great reminder that the most important piece of the puzzle isn't always the one that's front and center. And it really leaves you with a critical question to ask yourself. Are you investing for next quarter or for the next decade?